Live from New York City this morning. Good morning, good morning. A bit of calm after that mini bearish storm. Equity futures unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Winter is coming.
You're going to see more headwinds.
Europe is going to really face some very strong headwinds.
The pain will be concentrated around the winter months.
The data aren't great.
Conflicting data.
Headline data, was disappointing.
I worry that there is bad news ahead.
The Eurozone and the Euro is beset with a very ugly menu of problems.
Massive increases in headline inflation.
Surging energy prices.
Gasoline prices, supply chain woes.
High gas prices.
Recession in the U.S.
A mess.
There's further downside risk.
The winter is coming.
Joining us now to discuss all springs, George Bory, Emily Rowland of John Hancock Investments. Emily, first to you. Some people might argue winter's already arrived in Europe. The S&P 500 down 3.4% in 2 days. The Nasdaq down about 4.5% in 2 days. Do you think reality is starting to bite again?
I think it is, and this big backup in bond yields that we've seen in the U.S. really is a result of these elevated inflationary readings in Europe. In the U.K., over 10% CPI. You're seeing German PPI at the highest level in 70 years, a 37% increase there, causing this backup in sovereign bond yields, which has trickled over here to the U.S. with the 10-year Treasury now over 10%, and that's causing some challenges here to markets. Clearly, Europe is likely in a recession already, if not going there very shortly. And we are seeing a really kind of diverging path of economic growth here, with the U.S. still holding up stronger than the rest of the world, but clearly some challenges here as far as the global growth picture goes.
We spent the last couple of months wondering whether we've seen the low on the S&P 500 for the year back in the middle of June. We've got to work out whether we've seen the high on a two-year yield. We're up about a basis point today on twos, on tens up about 5 to north of 3%. On a two-year, 332. George, your thoughts on this? 332, the highs of the year on June 14th of 345 intraday. Can we get back to those kind of levels, do you think?
I think we can, Jonathan, but it's going to take some stronger data. As we just mentioned, the data is mixed. It's very mixed, both internationally and here domestically. Obviously, the world is focused on inflation everywhere. Inflation is still high. That keeps the Fed in play, and that will continue to put pressure on the front end of the curve. But that pressure is getting increasingly focused on the very front end of the curve. And as we move out 2 years and beyond, what you're finding is a little bit more of a range pattern for the yield curve. And so when we look at the curve, twos, fives, tens, all the way out to 30, this kind of, sort of 3% plus or minus around 25 basis points seems like a range that we're going to hold as we go into September and possibly even into the end of the year.
Into the end of the year, George? You think that long? Why?
Well, because I think the data, it's a very mixed backdrop. We're seeing pockets of weakness, but not a collapse. There's plenty of pressures. There's headwinds everywhere. We're looking for new headwinds. We don't see a lot of new headwinds. It's the old ones remaining more and more persistent. The one area of weakness that we see, housing. Housing in the U.S., very interest rate sensitive. You are seeing the housing data come down, coming well off the boil from a very, very strong market. That is one bit of new news. Everything else as it relates to inflation, as it relates to growth, it's sort of a retread of the same trend that has been persistent all year long. That means a consolidating market as we kind of go into the end of the year and the next new trajectory sort of ultimately emerges.
Emily, something Phil Camporelli said of JP Morgan this morning has stuck with me. He said just because the Federal Reserve is raising interest rates doesn't mean rates have to go higher. Do you agree with that?
We actually do, John. We think that because the Fed has made such aggressive use of forward guidance here, we've already seen a lot of the moves in bonds actually priced into the markets already. And what we actually look at is the leading economic indicators. A lot of, George made a great point that the data is very mixed right now, but a lot of what the Fed is looking at and what markets are looking at are lagging economic data. And John, friends just don't let friends use lagging economic data in making investment decisions. We want to look at where the leading data is going, and the Conference Board's leading economic indicators came in at 0.0% as of July. And there are still a number of elements in there that we think are going to see further weakness before we can start to declare a bottom. Now, typically when the leading economic indicators are falling, so are Treasury yields, because investors are looking for safer assets as this decelerating growth environment continues to play out. So we actually think that we'll see some choppiness in yields here, again, based on this mixed economic data. But ultimately, as we enter a recession, we actually see yields moving lower. That's typically what happens, and we do think that this time will be the same.
I have to say, you're on the same page as Max Kentner over at HSBC. We talked about his research yesterday. I'll share it with you again just in case you missed it. Our leading cyclical indicators all point to more broad-based weakness in the second half, with warning signs flashing for the housing market, for the consumer, and also increasingly for labour markets too. Goes on to say we'd likely add to DM sovereigns before sounding the all clear on risk assets. There's another way of looking at this too. Comes from Marko Kolanovic over at JP Morgan. He wrote this yesterday. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China should provide support for the global cycle. In combination with still very low investor positioning, it creates a positive environment for risk assets. George, your thoughts on that? Just those 3 points that the team over at JP Morgan are making, that inflation can resolve on its own, it develops into a Fed pivot, you get a stronger second half recovery in China to support the global cycle, you combine that with low investor positioning, and you've got a positive environment for risk assets. Do you agree?
Well, I think it's a very sophisticated view on markets. And we would really simplify that. And we'd say really since the middle of this year, the world has become a more bond-friendly place. Inflation is still high, but growth is slowing, and central banks are moving aggressively to bring down inflation. That equals a more favorable environment for bond investors. And so we think, as we just heard, that there are some relatively attractive opportunities in the bond market. It's not quite the time to sort of go super long duration, but taking sort of duration positions make a lot of sense. Selectively in credit, which is also materially repriced, taking, again, selective opportunities. And so the prospect for positive total returns in fixed income, we already saw a very good month in July, seeing also a reasonable month in August. We're likely to continue to see sort of ongoing improvements in the bond market as that data, as the economic slowdown emerges. And that to us is pretty constructive. It's a very sophisticated message that we just heard from some of our colleagues and competitors, but I think it can really be simplified down to, the world is just simply a more bond-friendly place right now.
I sense you're being very diplomatic there, George. Maybe some strategists getting too cute about the future. I'll try and keep things simple, Emily. If you're expecting a lower growth profile that supports lower yields, particularly at the long end, is that complemented by a softer inflation story too? And where does that come from?
Yeah, absolutely. And by the way, just to simplify things even further, we've been going with the hashtag bonds and chill, which basically means move up the capital structure, get paid income here. You're getting 3 to 5% in high quality bonds, including investment grade corporate bonds, and wait for this mini cycle that we've been experiencing since 2020 to continue to play out until we get into the recession. We do see, John, inflationary fears receding here. We do believe that inflation likely peaked in the first quarter. It is going to take a long time, though, for it to return to the Fed's target of closer to 2%. But we do ultimately see inflationary fears here turning to growth fears. We have to remember that the Fed is doing their job here to raise rates aggressively to dampen inflation. And ultimately, that's going to turn into demand destruction. We're already seeing signs of that. So we want to be really mindful about that in terms of positioning across portfolios, not only embracing bonds, but also looking for higher quality, more defensive assets in the U.S.
We've been asking repeatedly, raise to what and hold for how long? That's going to be a big part of the conversation with Chairman Powell in Jackson Hole, Wyoming, when we have that annual Fed get-together later this week. Jan Hatzius of Goldman weighed in on this. Take a listen.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean,
Really?
if you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
George, what do you make of that? Raise to what? Hold for how long? He's talking about 3.5% and maybe for 2 years.
I mean, yield staying, sort of having Fed funds up around 3.5% for an extended period of time is not atypical. It's very similar to what we saw, sort of prior to the credit crisis back in 2008. And so it seems like we're going back to sort of the old normal, not a new normal, and sort of an old normal where, hopefully inflation, sort of coming back down to sort of more normalized levels around 3% over an extended period of time. And you have Fed policy that's, sort of up around that sort of 3% level. So it will take time to get there. And that's, I would agree with what we just heard, is that, sort of that expectation for rate cuts in the second half of next year kind of seem a little less likely than what the market's pricing in. But expecting, sort of Fed funds to kind of collapse seems kind of unlikely at this point, and that you're likely to see kind of persistent inflation and a Fed funds rate that's kind of hovering in that 3 to 3.5% for an extended period of time.
Emily, if we go back to an old normal, in George's words, an old normal, where would you suppose the leadership in this equity market comes from?
Yeah, I think if you see, rates elevated here, that would, speak to some of the leadership that we've seen year to date. You see value stocks having an advantage here. You look down in market cap, maybe you see an advantage there as well. But our view is actually that, rates start to come down and the Fed does cut in 2023. We have to remember here that it takes 3 or 4 quarters for the actions that the Fed is taking to actually be filtered into the economy. So we don't think that it's been fully reflected in the economic data yet. We don't think that it's fully reflected in, really earnings data as well. So as we watch that play out, where we want to be allocated are areas like quality, which hasn't performed as well as we would have thought this year. So companies with great balance sheets, more durable profitability, ones that can hold up in a decelerating growth backdrop, we expect to see a bid there. We still want to own some value stocks. We want to have some cyclicality, some inflation protection in the portfolio. But I think growth and value can actually peacefully coexist in this environment.
Emily Roden, George Bory sticking with us. Futures this morning down by close to 0.2%. Let's get you some movers. Here's Abby.
John, let's go beneath the surface. That relatively flat surface after the worst 2 days for the S&P 500 in about 2 months. And take a look at what's moving more. First up, Macy's shares are popping on a very solid second quarter off of the pre-market highs. That may have to do with the fact that they cut the full year view, however, on, of course, the familiar story of a bloated inventory. Big discounting. It seems as though investors right now are taking the view that's more of a positive. Let's see if that gain holds. Intel off of its highs as well. The broader market probably pulling here. They've agreed to a deal with Brookfield Asset Management to invest up to $30 billion in Arizona chip factories. To the downside, Twitter down 3.6%. This, of course, on the story about a whistleblower lawsuit accusing the company of, quote unquote, lying about bots to Elon Musk, coming away from that share price, the offer price of, I believe, $54.20. Let's keep an eye on that story. Just keeps going. And then finally, Zoom plunging down 12.4%, down 83% from its 2020 peak, John. This, of course, after they cut the full year revenue forecast, having to do with weakness relative to their online business, offset a little bit by the phone and enterprise. But it's clear that those pandemic trends are waning.
Abby, thank you. Coming up, the global energy crisis intensifying.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Europe, we have a problem. That conversation up next.
We will go out of the use of oil in the end of the year, and we are decreasing the imports. And we are taking a lot of investments to become independent of imports of gas from Russia. So we get our gas from Norway, from the Netherlands, from the western ports of Europe.
That was Chancellor Scholz. Germany looking for alternative energy sources with surging prices crippling economic output. Belgium's Prime Minister warning the next 5 to 10 winters, 5 to 10, will be challenging throughout Europe. Nat gas prices surging across the globe amid mounting concerns over stockpiles. This as US gasoline prices post their longest streak of decline since 2015. We've had 70 straight days of it now. Team coverage begins right now with Jack Facci out of London and AMH here in New York City. Jack, I want to come to you, and I think this is so important. I think we all have a relationship with a barrel of oil that we don't have with gas. When you tell me the price of gas, I don't really know what that means in the same way. Natural gas. Jack, can you tell me just how bad things are in Europe with winter just around the corner?
Well, that's absolutely right, but I can tell you that people here in Europe now really do have a relationship with the price of gas, because we're all looking at our energy bills and beginning to understand quite how dramatically they're going to increase. So here in the UK, for example, the average energy bill, I mean, I can tell you my energy bill for my two-bedroom house costs about £100 a month. Goes up a bit in winter, down a bit in summer. It's now projected to go up to about £400 a month and could even be £500 a month. So that's, you know, one of the key bills that most people pay. We're looking now at really a significant proportion of the population, you know, even the quite well-off middle classes now really struggling to pay their energy bills, and that's being repeated across Europe. Depends a bit on different policies in different places where governments are taking a bigger part of the burden, but we're heading for a winter now where prices are going to be eye-wateringly expensive. You know, you look at power prices across Europe and they're something like 10 times the level that they were before this past year, and not just prices, but actually we're talking about shortages. So you have the Finnish grid today came out and started warning Finns that there's a very real possibility of rolling blackouts this winter because they're simply not going to have enough power to supply domestic customers.
Jack, you said a winter. The Belgian Prime Minister's talking about 5 to 10 of them. Jack, your response to that when you heard that?
I think that's right. Look, I think we need to take things one step at a time. The first issue is going to be to get through this winter. There's a real possibility of supply outages across different countries in Europe, but it's absolutely the case that we've all got used to power prices, gas and power prices in Europe being pretty cheap, largely on the back of cheap Russian gas over the past 10, 15 years. We're not going to have that anymore. It's very unlikely, whatever happens in the coming winter, whatever happens in the war, it's very hard to see how we're going to continue to have very cheap power prices on the back of large supplies of Russian gas. And so I think we need to get used to the fact that energy is going to be much more expensive.
AMH, we've had 70 days of it now, of gasoline prices coming down. Reason to believe that we can continue this trend?
Well, there is some reason to believe that, given the fact that you have China still in lockdown. At the same time, you're over peak driving season of the summer. But there obviously are concerns because you can have switching in Europe. If they're losing natural gas, they could start switching using oil. And also at the end of the year, those European sanctions on Russian crude start to kick in. And it's not just barrels of oil. It's the shipping, it's the insurance. So right now, the administration is going to the midterms with some very good wind in their sails in terms of gasoline prices. But I also be slightly cautious because what we heard yesterday in an exclusive interview with Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, said that he thinks there's a disconnect between the physical market of barrels shipping across the sea, as well as the financial markets, the paper markets that we track every day. And the words that he said is that basically they could cut at any time. This is just a month since the president touched down in Jeddah. And now the Saudis are pretty much putting out this idea that they might cut production.
I have to say I was surprised to read that yesterday, but I don't follow it as closely as you two. But that seemed ridiculous to me based on what we were calling for a month or so ago. AMH, Jack, wonderful as always. George, Emily, numbers we just don't usually talk about in Europe going into winter. And PMIs this morning, manufacturing in the Eurozone, 49.7. I think we had a 46 handle on the PMI in the UK. Emily Rowland, just a final word on Europe. How difficult is this going to be for this economy and for this market?
It's so challenging, John, and it's hard to have a conversation on the market implications when your heart just goes out to the folks that are struggling with these extraordinary prices here. And I think what I was watching for this morning in the PMI data is there has been a bright side in Europe as it relates to the services sector, tourism alive and well. I know a lot of us have traveled over to Europe and enjoyed that over the course of the summer. And we actually saw those services PMIs also moving lower this morning, which is a challenge there. So, from an investment standpoint, I do still think that there are opportunities overseas, but we want to be careful there given those relative economic growth prospects there.
George, I've got 40 seconds. Final word, sir.
Sure. So slowdown in Europe really reinforces the argument that the bond market should hold up in here, both government bond markets, but also to a certain extent selectively in the credit markets as well. While there's some pressure, there's obviously a lot of pressure on the economics. The value in European credit has actually emerged. It's lagged the U.S., and while there's still a lot of sensitivity to slowdowns in growth, pretty much the fundamentals look what we would call good enough for credit. And so from that perspective, from a bottom-up perspective, there's still good opportunities in European credit.
Hey, George, good to catch up alongside Emily Roden. To the two of you, fantastic, difficult, complex issues for Europe. Coming up, the morning calls and later, JP Morgan's David Leibovitz anticipating EM to lead a synchronized rebound in stocks next year. That conversation coming up. A few minutes away from the opening bell this morning. Good morning. Futures basically unchanged on the S&P 500, slightly softer on the Nasdaq after 2 big days of losses on both the S&P and the Nasdaq 100. That's the price action. Here are your morning calls. First up, BTIG downgrading Zoom to neutral without a price target, expecting profitability to remain under pressure after its quarterly results. Wedbush upgrading Denny's to outperform, citing positive channel checks and optimistic meetings with management. And finally, Macquarie initiating coverage on Baidu with an outperform rating, expecting online advertising to recover in Q1 of next year. Coming up, JP Morgan's David Leibovitz making the case for US equities. From New York City, this is Bloomberg. 24 seconds away from the opening bell this morning. Good morning. 2 days of losses, 2 big days of losses on the S&P, totaling up, amounting up to about 3.5%, call it 3.4, even bigger on the Nasdaq this morning. Futures slightly softer, negative about 0.1% on the S&P 500. On the Nasdaq 100, down a little more than 0.1%. As your opening bell, switch to the board and get to the bond market. Yields higher again on a 10-year by 4 basis points to 3.0535%. Cutting through the 3% level in the last 24 hours and breaking down through parity on euro dollar, 99.42, and coming very close to a 98 handle earlier this morning too. We're unchanged on that currency pair after showing a bit more weakness a little bit earlier this morning. Crude 92.30 up, let's call it $2, positive 2.2% this morning. That's the cross-asset price action. We open lower by about 0.1% on the S&P 500. Let's get you some movers. Here's Katie.
John, let's start with Twitter because there's a lot of drama around this name. You had Twitter's former head of security alleging in a complaint that, quote, there were egregious deficiencies in security protections. You then had Elon Musk's lawyers saying today that they've subpoenaed that whistleblower. That's, of course, after issuing a subpoena for ex-CEO Jack Dorsey yesterday. Shares lower off by 3% or so. Moving on, we've got some earnings to get to. Palo Alto Networks, rather. It's a cybersecurity firm. It reported a beat and raise quarter and a stock split to boot. Shares higher by about 10%. JD.com, too. Revenue growth beat estimates at China's second biggest online retailer, quieting some of those fears about a Chinese slowdown, at least for a day. Chinese internet ADR is broadly higher as a result. And finally, Devon Energy climbing from the bell. That's after U.S. natural gas touched $10 for the first time since about 2008. That's good news early for the energy sector, John.
Devon's up 59% year to date. There's a massive winner. And Katie, thank you. This one's been a loser over the last few years in a big way. Macy's, a loser this morning. If you're looking at the outlook getting cut, the stock up by about 2.5%. This is the quote from the company. Continued deterioration of consumer discretionary spending in some of its categories and the level of inventory within the industry, as well as the risks associated with a more pronounced macro downturn. Have you got enough buzzwords in there? Abigail Doolittle. Hey, Abby.
Hey, John. Well, this is an interesting one because we have such a mixed bag this quarter relative to retail. And on the surface, you would almost think that Macy's would be trading lower after cutting the forecast, as you just mentioned. But the stock is actually higher. It was all over the map in the pre-market, down sharply, then up as much as 5%. Right now, up 2.1%. Not bad for cutting the forecast. But you may have really nailed it earlier, saying that it's been a loser in recent months. The stock is down so much that bad expectations could be priced in. So investors happy about the fact that they actually beat the second quarter expectations. The full year cut maybe not as much as it could have been. They did cut the range. Now, some of it has to do with that weakness relative to consumers really not spending as much inflation, but it's also that familiar story of surging inventories, discounting to get rid of some of that, and then the delicate balance looking ahead to the holiday, having the right inventories for what people want. Now, relative to retail overall, inflation is really cutting into it because it's pretty interesting, John. If you take a look at retail sales out of 2020 on the rise, but if you take a look at retail sales in yellow relative to inflation, it's actually been declining since March of 2021. So this is a big part of what Macy's is dealing with. But right now, investors with that stock up a little bit seem to think that they're up to the challenge.
Well, that move stick. Abby, thank you. This move this morning, not much of one, unchanged on the S&P 500. Energy advancing by a little more than 2%. Information technology, can you call this a bounce back? Up by more than about 0.1%. Let's call it 0.2% higher this morning. It has been tough for the Nasdaq over the last few days. The bears in charge amid the Fed hike jitters. Katie Lyons, Real Yields back in charge.
Absolutely, John. Those inflation-adjusted yields are really critical here. Now, of course, we had seen a bit of a rotation back toward tech and growth as yields have come in, but as they've resumed their upward trajectory in recent days, that has led to 2 days before today of 4.5% losses on the Nasdaq 100. Its worst 2 days going back to the depths of mid-June. And of course, on the year so far, we have the 10-year yield up 155 basis points, and higher rates weigh on companies with higher multiples. We know that to be true. And the Nasdaq 100, as a result, down about 21% year to date. Even worse for the semiconductors, off by more than 27%. Now, I mentioned that reversal we had been seeing up until recently, where value actually was giving back some of the ground it had gained relative to growth. That is the blue line there, the Russell 3000 value ratio to its growth counterpart. The yellow is the 10-year yield. You can see how those two lines generally seem to track each other. Right now, growth is starting to wane once again. But as you mentioned, John, it really is that real yield that matters here. That is perhaps the truest gauge of borrowing costs, if we can ever find one. Those are up about 40 basis points just on the month of August so far. And that, of course, threatens to undermine equity valuations, more specifically rich equity valuations, and eat into their relative attraction to bonds, John.
Katie, thank you. The brilliant Katie Lyons. And really building on that, Michael O'Rourke of Jones Trading saying the following: despite the risk-off environment, inflation fears are prompting bond selling and pushing yields higher. As such, long-duration growth equities are under pressure. Taylor Riggs, you've seen it all week at the close.
We did. We really saw it yesterday, John, sort of a really decent here sell-off when you're thinking about some of those long duration assets. And like you mentioned, the relationship to yields and real yields, as Katie just pointed out, Kaylee just pointed out, I should say. It's really interesting, though, that we're focused on some of the more speculative parts of the market. When you think about the SPAC index, the IPO index, some of the more unprofitable companies, the meme stock ETFs, John, from peak to yesterday's close, you're off 40 to 50 to even 60%. So you're trying to get a little bit of a rebound today, but it has really been a choppy ride in the last few weeks. Now, we talked a lot about Bed Bath & Beyond. There's some fundamental news when you think about some reports of not being able to pay suppliers, a downgrade on the debt to CCC from S&P Global Ratings, but of course just really wrapped up in the meme stock as well. Some volatility, let's say, within this stock too. But John, it really isn't all that. It really sort of has been sort of a macro global story, right? When you think about peak to trough, where we've been a year ago, it really has been coming down a lot across all of these more high beta plays. So we've talked about the more speculative parts of the market, the memes, these high growth areas, but it really has been sort of this global narrative as well.
Taylor, looking forward to the close a little bit later. Taylor Riggs there breaking it down for you. Allow me to break down the market action right now. Not much price action relative to the big moves we've seen over the previous 2 days. The S&P up by a little more than 0.1%. Talked about where the leadership is coming from energy this morning, up 2.7%. It's been so defensive over the previous few days. It's kind of the opposite this morning, with staples, utilities and healthcare lagging. Healthcare down by about 1 full percentage point. The consensus view, though, is this one. Stocks set for choppiness into year end.
I do think that we're setting up for further volatility in the very short term.
Volatility will continue.
Volatility picks back up.
Continued inflation and, of course, a lot of basis risks.
General uncertainty about where prices are going.
What happens if oil prices start to rise? What's going to happen in winter?
There is this risk of more hawkish rhetoric from the Fed, from the central banks.
There's a lot of risk that isn't in the market right now.
That's a very challenging near-term mix for risk assets.
We have to set up for some choppiness and volatility through the end of the year.
Joining us now is David Leibovitz of JP Morgan. David, always good to catch up with you, sir. Let's start there. Are you getting more constructive or less so as this year progresses?
So I think that from a next 6 to 12 month perspective, it's reasonable to kind of echo the things that just flew across the screen. We think that volatility is going to persist. I think that the underlying driver of this volatility is going to be the rates market. I mean, you look at the MOVE index, you look at what is happening just in the spot market, and rates have been all over the place. If you can't figure out what the cost of capital is supposed to be, I'm not sure how you're supposed to price any financial asset. But this volatility from more of a 12-plus month perspective does create opportunity. And we think that over the next couple of weeks here, we're going to get more clarity from the Fed that could well induce a continued choppiness into the market. But longer term, we do think things will settle as we get more clarity on the trajectory of the Fed's policy rate, as well as the trajectory of inflation.
Forgive me for being the CIO of Hindsight Capital, but clearly looking back to June, that was the big opportunity to buy tech. You were more constructive on that. We talked about it, David. What about now, after that rally off the June low and the weakness that's kicked back in more recently? What about now?
So, things are obviously looking more attractive today than they did a couple of days ago, but we recognize that rates came in likely prematurely over the past couple of weeks. I think, John, the last time we were on, you very directly asked me whether I was buying into the rally we were seeing in risk, and I believe my answer was no. We thought it was a bear market rally. And so I do think you'll have another entry point. I do think that tech could weaken here before it begins to get stronger. But I think what's most important for investors to recognize is that the direction of travel for the economy right now is towards one of slower growth. And slower growth implies lower rates. Lower rates, as we know, can help support multiples. And so I do think that while the clouds are looking a bit dark today, over the course of the coming weeks and months, they should begin to break over the technology sector in particular.
Is that the old playbook then, David? Is that what we go back to? Have we not broken out permanently into a new regime? And I use that word permanently, loosely, of course, but I'm talking about a new market regime with fresh leadership, with different dynamics on the growth side, on the inflation side. Do you think we just go back to the old playbook?
So I do think that we go back to the old playbook. I mean, I recognize that inflation isn't going to dissipate overnight. This is going to be an 18-month journey, which hopefully gets inflation back down to levels that are more palatable to our friends at the Federal Reserve. But I do believe that at some point here, we're going to find ourselves in a world of 2% growth, relatively modest inflation, and that implies low rates. Importantly, the technology sector is very different today, particularly the profitable part of the tech sector, than what we saw in the late 90s and the early 2000s. And I think one of the things that investors need to recognize is that some of these companies can actually be relatively defensive. Yes, we're struggling to figure out, what's the right multiple to put on those earnings today, but those earnings, to an extent, have proven to be all weather over the course of the prior cycle. And so we do expect that while there may be a near-term opportunity in value and sectors and industries with more operating leverage, the direction of travel, again, is towards slower growth, and that should inherently benefit those growthier names.
David, that's the destination. Right now, we still have inflation somewhere between 8 and 9%. That's the story right now. To get it down to 2, what's the GDP price we need to pay up to get inflation down to 2?
So I think what's interesting is if you look back over time, it is very difficult to get the inflation genie back into the bottle without causing some sort of contraction or without having some sort of contraction in the real economy. Now, when we think about what that contraction would look like, I don't think it needs to resemble what we saw in 2020. I don't think it needs to resemble what we saw in 2008. If you actually look at the average decline in real GDP from the early 1950s through the late 1990s, it was 2 to 3 percentage points. And so we think that something, in line with that would, again, help get that inflation genie back into the bottle. And importantly, you're beginning to see signs that the economy is slowing. I think the third quarter is going to be better than what we saw at the beginning of the year. And we recognize that there were some idiosyncratic factors which pushed growth negative in the first half of 22. But the economy is slowing here. There's fiscal drag, there's monetary drag. The consumer has been beginning to come under pressure. And so I do see a path where we don't necessarily have the soft landing that the Fed is looking for, but we do experience the slowing in growth and the contraction in GDP that gets inflation back down to more palatable levels.
Slowing much more quickly abroad. We'll talk about that in a moment. David, you're going to be sticking with us. It's good to have you with us. Your equity market basically unchanged on the S&P 500. 12 minutes into this, the Nasdaq positive, not even 0.1%. Coming up, disappointing data feeding global recession fears.
In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but it's going to be a slow growth environment, below trend. The Fed wants below trend.
The latest US data up next.
I think the US doesn't have quite the same degree of headwinds as both China and Europe. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but it's going to be a slow growth environment, below trend. The Fed wants below trend.
Well, there's some terrible economic data out of America. With more, here's Abby.
There certainly is, John. We're looking at a big miss here for the S&P 500, the S&P Global U.S. Services PMI, 44.1. That is deeply in contraction. It's below the expectation of 49.8. This is, of course, the preliminary reading for August, and it's down from the prior reading of 47.3. There's no way to slice and dice that and make that look good, especially since many are saying that one reason that we may not be in a recession, services holding up. That is not the case here. The manufacturing PMI also missed at 51.3, and the composite in at 45, now down for a fourth month in a row. This is really pretty brutal data, suggesting, John, that, again, we could be heading toward a recession.
With one small caveat, it hasn't exactly lined up with the ISM. So we'll see if that lines up with the much more followed ISM. But that is a big, big miss to the downside, Abby.
It certainly is. And that's an interesting point. So the ISM, the companies measured there, they tend to be larger companies. So it suggests that the larger companies have more resiliency, maybe a better ability to plan for a recessionary type environment. So the smaller to mid-size businesses, they appear to be getting hit, especially in the services sector. But manufacturing, not too far above contraction either. But again, the overall S&P Global U.S. Composite PMI, their preliminary reading for the month of August at 45. 50, that is the demarcation between contraction and expansion. The composite overall deeply in contraction.
Not good. Not good at all. Abby, thank you. I'll tell you one thing it does line up with, the data out of Europe that we got this morning. We had a 49 handle on manufacturing on the PMI in the Eurozone. I think the UK was something like 46. The S&P global economist Andrew Hager saying the following: the numbers, quote, point to an economy in contraction during the third quarter. Declining output is now being seen across a range of sectors as economic weakness becomes more broad-based in nature. Good friend of mine, good friend of ours, Guy Johnson, joined us out of London. Guy, that data this morning on both sides of the Atlantic, not great, is it?
No, it's not great. Actually, I thought we were going to have the worst story to tell here, John. But just looking at that services data on the numbers out of the States does make me wonder about that. Yes, the data out of Europe are really, really bad right now. If the PMI data is about momentum, Europe really doesn't have any. The headline number has come down pretty sharply, 49.2. This is the headline comp number from 49.9 in July. Manufacturing is bearing the brunt. That's probably the difference between the States and what we're watching over here in Europe. But actually, I think the second derivative, if you look at what's happening with services, John, the numbers are not good there either, and we're slowing down rapidly. Major economies are suffering. Germany, we all know, is kind of on point on this one. But France is now slowing very, very rapidly as well. And the ECB is expected to tighten into this, and that is the big difference between previous cycles and this one. The ECB is expected to deliver 50 basis points in terms of hikes in September. The question is, where do you go from there? There is some silver lining to be found here, John, and that is that some of the inflation components within these data are starting to ameliorate a little bit, but it's only marginal at this point.
Guy, I'm looking forward to your coverage in about 10 minutes as Guy leads you towards the European close. Guy, thank you. Looking at the move at the front end, bit delayed, but yields lower by 3 basis points now at the front end, the 2-year about 328. Equities picking up just a little bit on the Nasdaq off the back of some of that, I guess up by 0.25%. David, you're back with us. You heard what my good friend Guy Johnson had to say about the situation. We're going to tighten into some of this weakness. We'll start with the United States, then we'll go to Europe. In the US, David, what do you make of that economic data we've got this morning? Because I can tell you a different story from one data point to the next.
So obviously a big miss in the United States. And frankly, we've been somewhat surprised with the resilience of the data as some of the higher frequency indicators we've been looking at, things like jobless claims, have been rolling over. You know, it looks to us that this was more a question of when. As opposed to a question of if. And so I guess to an extent, this kind of validates what we've been expecting to happen, you know, a bigger move to the downside than anybody expected. But, you know, the Fed has done a lot here, and some of the tailwinds that were present over the past couple of years are very much beginning to fade. And so, you know, as we were talking about before the break, we're kind of moving back into this environment that is very similar, I think, to what we saw in the aftermath of the financial crisis. And that in and of itself, you know, over the course of the next 12 to 18 months, hopefully begins to address the inflation issue in a more significant way.
We've got this weakness in Europe we need to factor in as well, David. Ed Yardeni, much followed Ed Yardeni of Yardeni Research, said the following: a severe recession in Europe might not cause a recession in the US, but it certainly would depress the earnings of many US corporations. He went on to say it would strengthen the US dollar further, which would also depress earnings of US companies with sales in Europe. David, are you factoring that into the parts of the market that you like and the parts of the market you want to avoid?
We are. We think that the dollar issue is one that is likely to continue to plague companies for the foreseeable future. I struggle to see how in the environment that we're in, we see a material weakening in the dollar. To me, that's very much a development for the other side of any slowdown, both in the United States, but more broadly around the world. And the situation in Europe is not good. You know, the probability of recession there over the next 12 months, we believe, is north of 50%. You know, as many have said on this show, the gas issue is a significant issue. The energy issue is going to weigh, particularly as temperatures begin to fall. We're in a very different position here in the United States, where we're effectively energy independent. And while, you know, at the end of the day, it tends to be the United States catching a cold that gets the rest of the world sick, I do think that, unfortunately, we are looking at slower growth globally over the course of the coming months.
David, just quickly, a final question from me, and I've asked this in different ways throughout this morning. Do you think we fully understand what is about to happen in Europe later this winter based on incoming information? And I really, really mean that. Do you think we fully understand it? Because when I hear forecasts like 18% CPI in the UK, and people go, wow, that sounds like a big number, do we actually understand what that could mean to the UK economy, to the Eurozone, etc.?
I don't think that people really grasp the severity of this issue. I think at the end of the day, we've been very lucky over the better part of the past 5 to 7 years, you know, really ever since the fracking revolution back in 2015, we've been very fortunate to have low energy prices, you know, effectively across the board. And that is a dynamic that has very much shifted here over the course of 2022 thus far. I think not only is this going to be a headwind for the consumer, and there's a whole social aspect to this that we need to be cognizant of as well, this potentially could be a headwind to industry, particularly in the Eurozone. And I do think that while there is a long-term solution in going green, getting there overnight is very difficult to do. And so I do think we need to buckle our seatbelts because it's going to be a tumultuous couple of months, particularly for our friends on the other side of the Atlantic.
Big time. David, thank you. David Leibovitz there of JP Morgan Asset Management. Thank you, sir. So what have we got? We've got data with a massive downside surprise in the US. Yields down at the front end, and we let out a ton of oxygen out of that strong dollar trade. The dollar index rolling over negative about 0.5% right now. Up next on the programme, I'll get you to the trading diary. That's next. This is Bloomberg. Let's call it 26 minutes in. Equities rallying in the face of some pretty ugly data out of America. Equities up 0.25% on the S&P as yields pull in at the front end, just a pick up on the Nasdaq by about 0.5%. We'll see if this sticks. That's the price action. Here's your trading diary. New home sales at the top of the hour. Minneapolis Fed President Neil Kashkari speaking at 7 p.m. Eastern Time. US GDP and another round of jobless claims on Thursday. Plus, the Fed's annual Jackson Hole get-together. We'll hear from Chairman Powell on Friday, and you'll get a ton of data too. We get you, Mitch, PCE deflator and personal income and spending data too. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.